Gary DeWaal here, and this is Bridging the Weeks for August 18th to 29th, and today is September 2nd, 2014. Good morning! Because I decided to take a vacation during one of the two slowest business weeks of the year in the United States, just preceding the country's Labor Day holiday, it's now been 2 weeks since the last edition of Bridging the Week. Summer, if not officially, is now unofficially over, and it's time to get back to work. That being said, during the waning days of August, there were a number of high-level enforcement matters in the financial services industry, including two anti-money laundering cases brought by a New York State agency that touched upon very topical compliance themes: the importance of having robust monitoring systems to detect potential issues, and not untowardly pressuring persons obligated to detect potential issues from accurately reporting on such problems. We have a lot to catch up on this week, so let's get started. The United States Department of Justice settled various federal and state civil claims against Bank of America related to its and certain of its current and former subsidiaries' handling of mortgage instruments and loans from 2004 to 2013. Pursuant to the terms of the settlement, Bank of America agreed to pay up to $16.65 billion in total, $9.65 billion in fines, and the remainder in the form of direct relief to homeowners, for example, through reductions in the principal of outstanding mortgage loans and new loans, and the establishment of a tax relief fund to help certain homeowners with their potential tax liability because their mortgage loan relief. The settled matters include charges related to conduct by Countrywide Financial Corporation and Merrill Lynch, companies acquired by Bank of America during the 2007 through 2009 financial crisis. The federal and state claims raised issue with Bank of America's packaging, structuring, and sale of residential mortgage-backed securities and collateralized debt obligations without disclosing negative facts about the quality of the underlying loans, and the bank's origination of risky mortgage loans, including making misrepresentations about their quality to Fannie Mae, Freddie Mac, and the Federal Housing Administration. These agencies insured or subsequently acquired the loans after they were originated. Separately, on a similar subject in part, Goldman Sachs agreed to a settlement with the Federal Housing Finance Agency for alleged violations of federal and state security laws in connection with Fannie Mae's and Freddie Mac's purchase of residential mortgage-backed securities sold by the company between 2005 and 2007. As part of this settlement, Goldman Sachs, on its own behalf, and for related entities and persons, agreed to buy back the disputed securities for $3.15 billion. Because of the current market value of these securities, the federal agency estimates the value of the settlement to be $1.2 billion. Goldman Sachs did not admit any liability or wrongdoing as part of its settlement. In case you forgot, Fannie Mae and Freddie Mac are government-sponsored enterprises whose purpose is to help expand the ability of financial institutions to grant mortgage loans by participating in the transformation of such loans into mortgage-backed securities that are sold in global capital markets. The Financial Industry Regulatory Authority filed an administrative proceeding against Wedbush Securities related to quote-unquote egregious and systemic anti-money laundering and supervisory issues from 2008 through 2013. In June 2014, the Securities and Exchange Commission also brought administrative charges against Wedbush and two of its executives for violation of its 2011 market access rule, among other related matters. PricewaterhouseCoopers was fined $25 million and suspended from accepting certain consulting engagements at financial institutions overseen by the New York State Department of Financial Services related to its issuance of a report to the New York State Agency in 2008 that failed to disclose certain wrongful conduct by its client, Bank of Tokyo Mitsubishi. This Pricewaterhouse report failed to include certain adverse information about its client that Pricewaterhouse had included in a draft report, but that its client had requested be removed from the final report submitted to the New York State Agency. Standard Chartered Bank is required to pay a U.S. $300 million fine as part of a settlement with the New York State Department of Financial Services over its alleged failure to fix anti-money laundering problems as required by a 2012 settlement between the bank and the New York State Agency. According to the New York State agency, this failure was, quote, because of a lack of adequate testing and analysis both pre and post implementation of the transaction monitoring system and failure to adequately audit the transaction monitoring system, end of quote. As part of its current settlement with the New York State agency, the bank again agreed to upgrade its transaction monitoring system and temporarily to suspend U.S. dollar clearing services for certain clients from the United Arab Emirates and Hong Kong, among other sanctions. Credit Suisse Securities USA agreed with the Chicago Board of Trade to pay a fine of U.S. dollars $120,000 because of its alleged failure timely to report various block trades between 2010 and 2012, and its inclusion of inaccurate execution times in reports to the Chicago Board of Trade regarding many of these same block trades. The Chicago Board of Trade also alleged that on one day subsequent to this period, Credit Suisse executed a block trade that did not meet the applicable minimum quantity threshold for block trades. Cipperman Compliance Services, a Pennsylvania-based provider of compliance services to registered advisors and funds, has issued a survey of mostly compliance professionals that suggests that not all financial service firms may be investing adequately in compliance resources. According to the company's analysis of its survey of over 110 persons associated mostly with asset managers, broker-dealers, alternative managers, and wealth managers, quote, a common finding was that firms are understaffed and underfinancing the compliance function, end of quote. The company's analysis found that, quote, while the majority of financial service organizations say they value compliance, few compliance professionals believe their firms are managing the burden well, end of quote. Most of the respondents were associated with firms with $5 billion US dollars of assets or less. Although Cipperman's survey may not be comprehensive, it is nonetheless interesting. And finally, the CME Group increased the mandatory waiting time to 15 seconds between entry of a request for quote and request for cross in Chicago Mercantile Exchange and Chicago Board of Trade interest rate options executed on Globex. This change was scheduled to be effective August 24th. The CME Group has strict rules regarding pre-execution discussions, as do other designated contract markets. I have a summary of these CME rules on the article version of Bridging the Week on the website. Check it out. Well, that's it for Bridging the Week this week. As always, there is more information in each article and more articles on the article version of the Bridging the Week on the website. Check it out. Until the next edition of Bridging the Week, this is Gary DeWaal. Have a great week, and ciao!